Okay, in this video we're going to talk about using a covered call to help protect you in a stock position. And covered calls are extremely popular, and I believe the reason they're extremely popular is that they do have a great benefit over against buying a put to protect your stock position. As you remember, buying a put gave you a very nice benefit in that it limits the amount of money you can lose on a position. It puts a floor in, but it still gives you an unlimited upside potential for reward. So that's the great advantage of buying a put as insurance. The downside, of course, is it does cost you money. You have to pay for that. And a covered call is very, very different. With a covered call, you actually collect money, and yet it still provides you some insurance. So that's pretty attractive. Instead of spending money for insurance, the insurance company actually kind of pays you, so to say, although there's no insurance company. In fact, in a way, you kind of become the insurance company, because what you're doing is, rather than buying a put, you're actually selling a call. Now, since you're selling a call, remember there's somebody else on the other side of that trade, and they're buying the call. So since they're buying, they're the ones spending the money, and they're giving the money to you. You collect that money. You collect the premium in this case. So that's pretty sweet. You sit there and collect these little premiums, and some people will do this month after month after month, and they will sell short-term calls. And you have time decay that works on your side, which is very, very nice as well, and provides a little income stream in addition to your stock position. And it does, in a way, provide some insurance to your stock position. Now, not nearly as much protection as buying a put does, and we'll see that here in just a moment. And it also comes with another price, and that price is opportunity lost. So, in other words, where buying a put gives you unlimited reward, selling a call against your stock position gives you a limited reward. And we will see that here in a minute. But while it does diminish your risk to the downside, it does not put a floor in. And therefore, your risk to the downside is still quite it can be quite dramatic. It limits it, but it doesn't put a floor in where the risk curve flattens out. It just makes it less than simply owning the stock. So let's take a look at that, and we'll pull up some risk graphs and some option chains and show you exactly what we mean by that. This is Burger King up here right now, BKC. I'm using TradeStation, and I use TradeStation for my options analysis. It's fine. It's a good program for that. So let's go ahead and pull up an option chain on our good friends at Burger King. Okay, so here's our option chain on Burger King. By the way, it's the weekend, so some of these numbers up here are going to be a little crazy. You know, the bid is 0 and the ask is 24. But it traded at $19.91. That was the last trade, roughly $20 on Friday. And I'm recording this February 2009. It's actually February 8th, which is a Sunday, just to let you know. So if we looked at the February options, well, we've only got, what, about 11 or 12 days or so before these expire. So it's going to be pretty close. So again, what we want to do is, here's our calls on this side, here's our puts on this side, here's our strike prices right down the middle. Here's our bids and our asks. You'll notice there's quite a spread on these, and that will often be the case with options. So that's a problem. And when you look at which options you want to buy or sell, you want to look at a couple of things. The more actively traded options and stocks tend to have tighter spreads. So of course that's good. Also, you don't want to choose options that have low volume and have low open interest. Look at those things on every option that you consider buying or selling. because if you get into an option that has a low open interest and or volume, you may not be able to get out, and you can get may not be able to get out at all, or just have to pay a hefty spread. But some options meaning expiration dates and strike prices are more heavily traded than others, and so you want to get in on those where other people are actively trading. Tighten up those spreads. So some of these spreads are pretty wide, that's a 90 cents, well no, that's a $1.10 spread right there. So that's pretty wide. If you think you can split the difference, sometimes you can, most of the time not so much. I trade options through Interactive Brokers, and Interactive Brokers gives you access to all kinds of different option exchanges, so you can go for the best pricing on the different option exchanges, and that does help. It really does help. So that works great. But still, some of these spreads can be a little brutal. So if they're too wide and I can't get a good price, I just pass on it. I just don't take the position. It's as simple as that. But anyway, just a warning on that. And slippage is also an issue. It's some of the big problems with options. I've met option market makers, and I'm sure they're nice people, but when it comes to taking the other side of your trade, they're not generous. Let's just be polite about it and put it that way. That's being very polite. It used to be in the days of yore, the pricing of New York Stock Exchange, NASDAQ, and so forth favored the specialists, the market makers, and so forth. Not so much anymore. Ever since we got away from fractional trading, went to decimal trading, electronic trading, all these things have really cut into those people's edges and advantages and favored the screen trader, the retail trader. Options, on the other hand, still the market makers have a huge edge over the screen trader and the retail trader. So don't let them have that edge. And if they have it, such as in a case like this, just pass. Now, when the market starts actively trading, some of these spreads could tighten up. As I said, right now it's not accurate. Obviously, this is your bid and that's your ask. So the bid now is 0 and the ask is 24. Obviously, that's meaningless because it's the weekend. This is the last price it traded at, so that's the one we're going to be looking at right now. Okay, so about $20. Let's say we wanted. Oh, and by the way, the other thing is, now remember, we're selling an option now. So when we're selling, we want a high price, right? You want to buy low, sell high. So we want a high price. Now, the further out you go month-wise, if that's a word, which it isn't, the more money you can get. So, for example, $20 strike price here, the bid, they'll pay you 65 cents. But for March, for $20, they give you $1.35. Here's the $20 for July. They'll give you $2.45. Multiply that times 100, because each one of these is worth 100 shares of stock. You would be able to collect $245 for the 20 strike price July 09 Burger King options. Okay, and maybe even a little bit better if you can get inside that spread a little bit. Usually you can if it's actively traded, maybe not quite halfway, but you can usually get a little price improvement on the ask price, or the bid price in this case. Okay, so let's look at that as an example. Now, the downside, of course, why are they paying more money for the July than they would be for the March or for the February? Because it gives them more time to be right. It gives them more time for this, for the price of Burger King to get above $20 and get in the money. In the money means that the strike price is above the, the strike price where they bought the option at that time is below the current price. So, for example, somebody, maybe last month, they bought a July Burger King. They didn't do this, but let's say they bought it at $10. Okay, well, that now is worth $9.80. Why? Because they could turn around and they can exercise their option to buy the stock now at $19.91. So they're going to make, roughly 10 bucks. So that's great if, Burger King was at $10 back then. Now we just saw the chart, we know it wasn't. But if Burger King was at 10 and they bought the $10 option, then that option would have been a lot cheaper then. Now, if you go in, you say, well, I'll buy that $10 option, and then I'll just exercise my right to buy Burger King at $10. I'll turn around, I'll sell the stock at $20, I'll make a $10 profit. That's not really going to work because look, these options already have that $10 built into them. That's intrinsic value. Market's not going to just give that money away. So that intrinsic value is built into the price of the option. So what you need is time. You need time to go by to be right. And you're going to pay for that time when you buy an option. And so you're going to pay a higher price the further away the expiration date is. Well, as a seller of the option, that works in your favor on the one hand because you'll collect a higher premium. On the other hand, of course, it does give the person who bought the option from you more time to be right, for them to get that stock in the money. And if Burger King goes up to, say, $30 before July, well, now they will be in the money $10. And these prices, of course, will all be changed. And the difference in the option will be at least $10. That will be built in. And they got it for, $2.45. So will they exercise that option away from you? Oh, yeah. Of course. They'd be stupid not to. So you don't want that to happen. So what you really want is, since you're going to get a covered call, you are buying the stock. So you do want the stock to go up, but you don't really want it to go up too much. In other words, you don't want it to go up enough that it goes in the money. And because otherwise someone will exercise it, and then you got to sell them the stock because they get to buy the stock. Now, of course, you can turn around, and before they do that, once it starts getting close to in the money or in the money, then you can turn around and just buy your option right back and close out of the position. But you'll take a loss on the option. Okay, so, and by the way, it's called a covered call because you actually have your sell position, your right position covered with your stock. You own the stock, right? That's what we're doing. We're buying Burger King stock, 100 shares. We're buying, or we're selling one contract against that. So if you were to just purely sell and not own the stock, that would be a naked right. You're writing the call, but you don't have any collateral against that. And these are leveraged positions. And again, if that stock goes in the money and that person wants to exercise their right, you got to sell them the stock you don't own. So therefore your brokerage will require that you have a certain amount of money in your account to cover that should that happen. In this case, the stock itself is there and covers it. So that's basically how it works. So now we want to, of course, now that we know all of that, what we want to do is we want to sell a call out of the money. So let's say that we're going to do a, well, let's see, it's at about 20 now. Now the good news is, sort of good news is, as you saw on the stock chart, Burger King's going down, right? It's going down. So we could, knowing that, we could be a little more conservative. We could say, well, it's going down right now, so maybe I'll just sell a 22.50 call. Of course, it's got plenty of months to go back up. And so, but if you did that, you would collect a premium of $1.45 or $145. If you said, no, I want to be a little more conservative, I'm going to sell the 25 call, well, now you'd only receive an $80 premium. Okay, so let's bring up a risk graph, and just to illustrate, we'll do the 2250 call because it'll show it more clearly on the risk graph. And again, because Burger King right now is moving, the price is moving down, so we'll play that game and see how that works out for us. Okay, let me bring up the risk graph. Okay, so here's our risk graph. Now, let's talk about this. So the magenta line here, that is your stock position. And the stock position always looks like this. It's just a vertical diagonal line. Okay, 1991 is right about there. So we're buying it at 1991. Here's the stock prices down here. And this is your P&L over here. So at 1991, where we're getting in, we've made no money, obviously. If it goes up from there, we start to make money. Basically, for every dollar it goes up, because we're buying 100 shares, we make $100. For every dollar it goes down, we lose $100. And that's it. So every risk graph of the stock will be a diagonal line, and it's that simple. Now, this green curved line here, that is the call that we've sold. So, as you can see, the higher the price of the stock goes, the more money we lose out on. But if the stock price goes down here, then we actually make some money, and that is the premium we collected. The most we can make on this is what the buyer of that call paid us, that premium. So it's going to be limited. It's just under $200. Okay, now the blue line here, let me take all of this stuff off. The blue line is the composite of these two positions, the stock and the call that we sold. So the blue line is really our position, and this is the position as it will appear at expiration, not as it appears right now. These risk graphs change over time, but this is how it will appear at expiration. So the two things to notice here are, number one, at the time that we buy the stock here at 1991, really, this is our position because we got paid a premium on that call option. And so therefore, we're already in profit. Okay, that will be, we're in profit by that much. So we're already, instantly in profit. Well, that's kind of nice. People like to be instantly in profit. If the stock goes down, then our composite position goes down as well, but by not as much money. And so you see the spread here. So it never flatlines. There's no floor to how much money we can lose, unless, of course, the stock goes all the way down to zero. So it keeps going down, keeps going down, keeps going down. But you see, again, the distance between these two lines is the premium we collected. And so if the stock goes down, we will keep that premium, and so we would just lose that much less. On the upside, the problem is that whereas the stock continues to go up and there's unlimited potential reward, our composite position does not have unlimited potential reward. It has unlimited potential risk, again, down to zero actually, but it has a limit to the reward, and that's because, again, there will come a time when that option will be in the money and be likely to be exercised away from us. And so therefore we will be, you're kind of fighting yourself here between wanting the stock to go up but not too much. And this, so your reward is limited. Now remember, again, this is just as long as you hold that option position, which you can buy back anytime, potentially at a small gain or a loss if the stock does go up. And so the disadvantage of this approach, covered calls, is even though it does protect you somewhat to the downside, it doesn't by a whole lot. And number two, your reward to the upside is definitely limited. The advantage is that you are instantly collecting some premium, and it gives you minor downside protection. And if you do this month after month after month after month, it can give you a little bit of a cash flow. Again, you see that when you do the short-term options, you're not collecting a lot of premium. It's not a lot of money. But people seem to like the little bit of income stream concept. And doing it on a short-term basis makes it less likely that the stock will go in the money and you get exercised. So that is the second strategy, and now we'll move on to the third one in the next video.